we bought a note for just under 30 grand. And what we did is we offered the guy cash for keys for deed in lieu. So instead of foreclosure, he signs the deed over. Property was worth 120 grand. We sold it for 97. This all took place in about 3 months.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com. Hello and welcome to episode 155. My guest today is Adam Adams, an apartment investor out of Dallas, Texas. Now, Adam has also done some syndication. He's also an experienced note investor. So I think this is going to be a really good conversation because I'm interested in both of those things, and I've been doing both of those things as well. Adam, I'm looking forward to learning more about you. Thanks for being on the show.
Yeah, my pleasure. I enjoy talking. So,
well, you've certainly helped me with a question that I had a couple of weeks ago, and I really appreciate your insight on note investing. And I do want to get into that, but before we go too far, why don't you tell us a little bit about yourself and how you got started investing in real estate?
I'm actually an IT guy. Been in IT for quite a while doing database development. When we were in Houston, we decided to move to Dallas, and we could not sell our house. That was 2011. So we started renting in 2012. So I became a landlord. The funny story is that my wife, her idea of investment was a savings account. But we got to Dallas, and I don't know what got into her, but she found Brad Semrock, who does apartments. And so we went to his sessions, and then we joined his group, and we've been in apartments ever since. So that's how I got into that. Did a lead on a few deals and passive on the rest. And then I met a guy in apartments who did notes, turned me on to notes. And then, I've been doing notes ever since. And still doing a little bit of apartments here and there, but mainly doing notes. So.
Wow. Okay. So there's a lot there to talk about. Why don't we start with what you learned from Brad Semrock and his program and how you applied it to your first deal? What was that first deal?
Oh, it was a 11 unit, and we were a lead, not a lead, but KP. We signed the note. So
explain that for our listeners. When you say you're the lead or the KP, what is that exactly?
The lead. Well, he's the one that gets the deal, organizes everything, runs the show. Here's called a lead. Then you got KP or a key principal, where they're actually a signator on the loan. So if anything goes bad, they come after the KPs. Usually the lead's on the signing the paperwork too. Then you have just total passive. And those are the guys that just give the IRA money and just sit back and get the reports and the checks. And, those are the three different principles in an apartment syndication, really.
So tell us a little bit about this 11 unit then. Where is it located, and how'd you find it, and how'd you take it down?
It was in Irving. It was.
Is that Irving, Texas?
Oh yeah, sorry, Irving, Texas. And then what was that? That website that has all the apartments that no one really looks at because it's like the dregs of society. Oh,
you found it on LoopNet?
Yeah, LoopNet, yeah. But no, that's where we found it. It was a mom and pop owner. So all the books and receipts were in a shoebox. Had to go scroll through everything once we got it in our contract. But that was back in the good old days when, because I remember on this one, we actually walked away from the deal and then they came chasing us, accepting our lower bids and stuff. And, but that doesn't happen anymore. So, those are the good old days.
Yeah, that was the buyer's market back then.
Yeah. Now it's the other way around. And it's kind of weird. I don't know how many deals I walked away from because I like, man, you guys are crazy wanting, 40 grand a door or 50 grand a door. Now the same doors are selling for 80 to 100. I'm like, man, I should have bought that stuff, But, you don't see what's coming, and, it didn't fit the model. And, the model is not double the money, double the value in 2-3 years. That's not the model. So we're kind of in a freak period of economic growth with multifamily.
Yeah, right now we're talking, it's October 2018. Very different market than it was back in, what was it, 2011, 2012 when you bought that 11 unit?
Yeah.
Yeah, so we've seen just huge, appreciation in values, and you're saying it's a freak period. What do you mean by that?
Well, it's not the norm. Normal, you should maybe double in 5-6 years. Now you're doubling right now in 2 to 3. I think those days are gone. I think we've already maxed out. I mean, I know we have because, if you watch the reports, the rent growth maxed out July 2016. Ever since then, it hasn't been negative, but it's been lowering.
Yeah, it's somewhat plateaued from my experience.
And I think even in Dallas, first quarter of this year, I think there was a negative rent growth. But, that's A's, B's, and C's, I get in debates all the time, like, are you talking about the A class? Yeah, they're going to have some upheaval, but we invest in C, so they're more stable. But, things trickle down,
Yeah, well, explain that a little bit. A's versus B's versus C's. First of all, how do you define an A class property versus a C class? And why do you feel that C's are a little bit more stable?
Oh, I don't think they're more stable. I think that whatever happens to A class is going to be your new builds, your luxury stuff, brand new buildings. Your B class, is going to be a little bit older. I would say anything from the 80s to now, would be a B class, maybe an A minus, Your C class is going to be your working class, your blue collar. You're going to be, a lot of people with the labor jobs are going to be in these units, and they're going to be older. I've seen, I guess it depends on where you are in the country, but, in Dallas, we're talking 60s, 70s models. And then your D class is basically a C class where they don't maintain the property and it becomes a slum. So we don't do D class, but we do, a lot of C's, and we've been moving more into B's because we found that the any repairs you have to do, or they're more recent on the code, and so they don't cost as much to rehab. I think we had a burn in one of the units, and a fire in one of the units, and the walls. Once you take off that drywall, then you got to get all the code up to date, and it costs a lot of money to get that code up to date, all that grandfathered stuff. But that's why we've been moving more into B's. So.
How do you feel about just the stability? Because it sounds like you agree with a lot of the economists and people I've been talking to, which is that the appreciation that we've seen up to now is just, it's not sustainable. Possibly there's a recession on the horizon. Who knows when? How do you feel about the stability of the B and C class apartments in that period?
Well, I think whatever happens to A will trickle down to B and then eventually to C. So I'm not saying that C is unstable. It's just, and it might not, whatever happens to A, I think it's going to happen to C. It's just going to take longer to get there. Does that make sense? Mm-hmm. Because, the A's are going to lower their prices, lower rents, more concessions and all that. So that guy in the B minus is like, oh, I can afford that nicer unit over here. Because they're giving things away. So they're going to move over. And what's B going to do? They're going to lower their prices and get more concessions. So the C's are going to move. And I'm talking about the tenants, And then next thing you know, you got that C minus that you had, and all your tenants are moving out. Well, what are you going to do? you're going to defer maintenance. You're going to lower your prices. Anytime anybody's writing a pro forma, they're not lowering their rents on future growth. They don't do that. You're not going to get any money from investors if you put on your pro forma. Yeah, I expect 2% rent decrease over the next 2 years. You don't get anybody. So the problem with that, though, is that loans are based off of pro formas, and you don't hit your pro forma. Well, what are you going to not pay for? You're not going to pay for a loan, or you're not going to pay for maintenance. And it's always the maintenance that gets dropped first.
Yeah. So the pro forma being just your projections of how the property is going to perform going forward. In doing your pro formas, and I know that you're kind of a net seller right now, but in doing your pro formas, as you look at any potential acquisitions, how do you project your rents?
Yeah, 2% growth. Problem is that's not true today. That's 2% growth is normal. That's average over a long period of time, but it's not normal right now. It has been growing a hell of a lot higher than 2%, but like I said, Dallas had a rent decrease. So how do you? If I projected 2% and rents actually went down by 2%, well, I'm off. I'm way off, and that's going to cause my numbers to really get screwed up. Now, the big thing to understand is that you got different types of loans out there, and that's the big thing. A lot of guys I've seen a lot of bridge loans, 1 year, 2 year, 3 year. And you buy the property, you got 3 years to get it stable, to make it Fannie Mae compliant, so you can go get that non-recourse loan that's 12 years old, or got a 12-year term on it. Now you got a 12-year term, well, you can pretty much weather any economic changes, so you don't lose your money if things go bad. But if you got a 3-year bridge and the economy turns in two, and now you got to get refinanced at the end of that bridge, and you haven't met your numbers, how are you going to get refinanced? You're going to have to pay a hell of a lot higher interest rate, or you're just not going to get a loan. And now you got some serious problems. Now you got that lender with that bridge, pay up or, hand over the property. And believe it or not, nothing is new in this world. This actually happened back in the 70s. We had a huge apartment boom in the late 70s, early 80s, and then we had the whole S&L crash. And if you go to South Dallas, there are still some huge abandoned apartment complexes that never got finished.
Really?
It's weird. It's like going, Germany after World War II and seeing all the shells of these buildings. There's some of that down in South Dallas. But South Dallas, if you don't know, it's not the favorable part of town. But these are all, the shadows, the skeletons of, the 70s and 80s.
A little history lesson there for everybody to see. I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. That is kind of a warning sign to say, hey, everyone thinks it's a hot market now, but it can turn. And
can I talk about why? Well, that's my theory on why.
Love to hear your theory.
All right. So Dodd-Frank corrected, the mortgage industry. And I put corrected in the quotes, What it did is it made it harder to get loans. And when they were building new homes, they put on more restrictions, or not regulations. So it costs more to build a home. What that did is it made it less appealing to build a $100,000 house. Okay, if it's going to cost me all this money, I might as well build the $400,000 house and get the money. Why waste my time on the $100,000 house for that first-time home buyer? because my margins are a lot thinner. So lower end housing got more expensive. People couldn't get loans because the restrictions got tighter, and so that drove. Either you're a homeowner or you're a renter, one of the two. You're not, except for the homeless, but you're a homeowner or you're a renter. So all these homeowners got pushed into renting, and that's my theory on why we see the apartment boom and the storage unit boom. Because if you don't have a house, you got to put your stuff somewhere, and that's why the storage units went up too.
Yeah, self-storage, yeah.
Yeah.
So do you see that trend changing for any reason?
Well, a lot of the smaller banks got wiped out with Dodd-Frank. In fact, I think California, most of the smaller ones got wiped out. They just get, merged or, sold to other banks. But unless Dodd-Frank changes for the big banks to lend to smaller, folks, I don't mean small, but, lower income, you're not going to see. I don't think you're going to see a change. But if they do fix Dodd-Frank like that, then I think there's going to be a big change. So just depends.
Yeah, very interesting take on that. So how is all this affecting your portfolio? Because I know that you're a net seller right now, although you are still looking at deals. Why are you selling instead of buying?
Well, when the market's high, you sell. That's the old rule, Buy when it's low, sell when it's high. And right now, the cap rates are so packed. I can't buy anything. It's not that I'm not trying to buy. I just can't. We lost a deal. $17 million was the offer, and we offered 320 hard money, non-refundable money.
320,000 non-refundable hard right away?
Not us. We like to get a couple of inspections in first, but we lost. Okay. Because we lost to the guy that bid $17 million and $1 million hard money on signing the contract. Signing the contract. Yeah.
So even if he decides after inspections he wants to walk away, he's out that $1 million.
Right.
Wow. Now, that's quite a commitment there.
Some definitions, you might call that a bribe. I mean, really, this non-refundable hard money. What's the difference between that and a bribe?
Mm-hmm.
But that's how nuts it is right now. It's $1 million non-refundable.
Yeah, that tells you a lot about the market, and just it either tells you a lot about the type of money that's chasing these deals, or just the market in general. Because there is something to be said about the people who are, or the groups, the institutions that are willing to pay $1 million non-refundable.
Yeah, it's crazy. So we can't buy. We try, we look at stuff, but I just can't put myself to that point where, I have a hard enough time with $100 non-refundable escrow. So I can't do $1 million. I can't sleep at night. So
yeah, that would certainly keep me awake. When it comes to rental property insurance, understanding the costs, choices, and benefits can be overwhelming, and finding the right insurance provider can be frustrating. I had one company cancel 5 of my policies all at once for no good reason, and that's why I'm happy to have Mike Murphy from JB Harrison Insurance on my team. Mike is an independent agent who has always been able to find the right policy and the best provider for my insurance needs. Over the past 5 years, Mike has not only become my go-to insurance agent, he's also helped me manage risk, add value, and save money. If you are looking for insurance on a new acquisition, or you believe it's time to get a more comprehensive look at your entire portfolio, then Mike Murphy is the independent agent to call for all your insurance needs, auto, home, and business, at 616-868-0050, or email mikem@jbhins.com. So you have an interesting snapshot in time here, because you started investing in 2011. You've been selling off assets up to this point. What types of returns were you seeing during this period of time?
In apartments? Yeah, double. In
apartments, just in the cash on cash, and then annualized returns once you sold.
Doubling our money within 2 to 3 years.
Wow.
Yeah. Now, I tell you though, that's That's been a nice short run, but it's not there anymore. I think if you're buying an apartment today, you're not going to get the same return.
What should you expect?
I also thought people were nuts paying $50,000 a door, 3 years ago, and I was wrong on that. So
Yeah, that's the thing. I mean, you know that at some point the party's going to end, but you don't know when. It's really hard to call the top. What should realistic expectations be now, given the conditions you see now?
And I really think you should stick with the whole 5-year model. Right now, I think everybody we're talking 8% cash on cash, and then at the sale you get your 80 to 100% after 5 years.
Yeah, so annualized, if you add up all your cash flow and profit at sale, you get an 80 to 100% return.
Yeah,
over a 5-year period.
Yeah,
that still seems realistic to you.
Yeah, unless something changes with the apartment legislation or something, or lending. If they make it easier to lend, then I think that would change overnight.
You were doing the multifamily. At what point did you get into notes?
I was a guy I met in apartments who got me turned on to him, and I think the biggest thing that attracted me to him was, as a passive, getting an apartment deal. The minimums I'm seeing to get in on the deal is 75 to 100 grand. So, yeah, I know I got a ton of money. I'll just, I can get in a dozen of those deals, but that's sarcasm, by the way.
Well, let's step back and just tell us how you found out about notes.
I just know the guy in apartments. And the funny thing is that he got me turned on to him. So I got more into notes, and he left apartments. But he, it's been 5 years now. He's dropped notes and he's back into apartments. So I don't really know where he's going with it, but I still like notes a lot. But I started doing some education with notes and learned what I could. And I don't have, I got nothing but warnings about notes if anybody wants to get into them, because there's no education out there that I know of. I come from Brad Sumrock. Brad Sumrock is great at teaching about apartments. There is not a Brad Sumrock of notes. So like Brad Sumrock or any, there's a lot of people out there who teach on multifamily and apartments. It's a very nuts and bolts process. You can learn step by step how to do it. Tell us, just for those who are listening and are like, what are they talking about? What are notes? Explain what you mean when you say you're investing in notes. Oh, okay. So I bought a house here outside of Dallas, and I went and got a mortgage. And so I got a promissory note with a deed of trust. And so that promissory note, that's what I buy now. I buy other people's promissory notes.
So you're buying other people's promissory notes. You're not buying the property. You're buying the note or the mortgage that basically controls the property?
Yeah, I only buy notes that are backed up by property with equity. No, I'll take that back. That are backed up by property. Mm-hmm. So, yeah.
Typically on what? Single families?
Yeah, single family. I'll go up to, if I can find a duplex, I'll grab a duplex here and there. Because, it depends on, everybody's got their own model for notes. And I don't limit myself to, one type of property type. I look at, 1 to 4. If I could find an apartment with a note, I might consider that too, So one thing I'm not doing is retail because I don't know enough about retail to look at notes. But yeah, there's a note for everything out there.
So the underlying asset, you prefer to be residential, 1 to 4 units, or if you were to come across an apartment note, you would buy that. So take us through your process. I mean, using an example of an actual note that you bought, give us a sense of like what you looked at, what parameters you used when you purchased it, and what kind of profit you made off of it.
Okay. We bought a whole bunch down in San Antonio, Probably everybody tells me it was the purchase of a lifetime. I think they're correct. So yeah, I can't repeat this model. But
so this is a best case model here.
Yeah,
and it sounds like you bought a pool, which was more than one note. It was a multiple notes that were from the same
bank,
lender.
Yeah, same bank. So 31 notes. I think there was 2 seconds in there, or junior liens. Everything else was a first, and all but 2 of them had balloons on them, 15-year balloons. So we bought them all at 55 cents on a dollar.
Were they performing or non-performing notes?
Some were semi-performing. They were all sold as non-performing, but some were better than some were performing so well that we bought them from a bank in Texas, and then I sold them to a bank in Michigan. I bought them for 55 cents on a dollar. I sold them for 85 cents on a dollar. So I bought from one bank, sold to another bank.
Wow. So you wholesaled all 31 notes?
Oh, no, just two out of the 31.
Okay.
We turned around and sold that. But I actually had them sold before I bought them. But yeah, I bought them and then did all the paper transfer and all that stuff. And then, transferred over to the other bank. So
when you say you bought them at 55 cents on the dollar, that means for whatever was owed or the outstanding balance.
The principal balance.
The principal balance.
You have principal balance and you have unpaid balance or payoff.
Mm-hmm.
Payoff might include unpaid taxes, or if I pay the taxes and not the borrower, then I advance their account, and so their principal is 20 grand, but I paid 1,000 in taxes, so their payoff it would be 21 grand. Principal is 20 grand, payoff is 21 grand. So I bought all these off of the principal balance. So I bought it off 55 cents of 20 grand. But with that debt I do buy does include that 21, that $1,000 advance. So, you bond the entire debt, but it's usually based off of the unpaid balance.
If you were to take over that property in foreclosure, there's the equity that's in that property as well that you would recognize.
Yeah, but there's, let's say I paid 20 grand for that note, or the note was 20 grand. I paid 12, let's say. And let's say the property itself is worth 100 grand. I go to foreclosure. People have this big conception that, look, I paid 12 grand, I'm going to get a $100,000 property. You're not, okay? That's the bottom line. You're not going to get it because you're going to foreclose, and then it's going to go to auction. And then there's going to be 40 guys out there at the courthouse bidding on it. And it's going to get priced up to 70 grand. So it's that property sells for 70 grand. I am owed 21. So that's what I get paid. I get paid 21. Everything between that 21,000 and the 70 grand that was paid for goes to the borrower. If I want that property, I have to go stand in front of the courthouse too. And I have to go bid it up. And if I bid it up to 70 grand and I win, well, I got to pay the difference between the 21,000 that I'm owed and the 70 grand that I bid. So that's another $49,000 I got to pull out of my pocket to get that property. So don't buy the note thinking I'm going to go buy curtains for this place, because if it's got equity, you're probably not going to get it.
So what happens to that equity then? If someone does bid it up to 70 and you're only getting 20, where does the other 50 go?
Well, there's another lien on it. Everybody that's owed gets paid off first. Anything that's left over goes to the borrower.
Oh, so the borrower gets a cut of that too then.
They get the equity, yeah.
Interesting. Okay. So that's a good lesson to learn there. I mean, it may be worth 100,000, but you can only assume that you're going to get the unpaid balance.
Yeah. The biggest thing that everybody seems to have a hard time wrapping their head around is you're buying debt, not property. So, that's a big thing. Now, let's say it's the other way. Let's say let's say you paid 70 grand for this note, all right? And it's, all right, let me try to phrase this a different way. you pay 50 grand for a $100,000 property. You pay 50 grand for the note, but remember you have that payoff. All those unpaid taxes that I paid for as a lender, insurance, court fees, all that other stuff. Let's say that balance is actually 120. Okay. So technically I'm owed $120,000 on a $100,000 property. So this property is underwater. Now I can go to auction, and as the lender, I can say my bid's 120. Well, no one's going to bid over that because it's only worth 100. So now I will get that property. Now it's an REO, and I can do with it as I want. Only problem is I just paid 120 on paper for that property. So guess what my property taxes are going to be based off of?
You've just posted your property tax.
Yeah. So the key is to try and find a price that works. So if I paid 50, maybe I'll bid 80. I'm owed 120, but I can bid 80. And if someone comes in and bids 81, well, I just made, $31,000. So I'm not going to cry about that at all. And I don't have to worry about rehab and all that other stuff. So, it just depends on how you play it. But you got to be aware of all these things when you're buying the note.
So with those 31 notes that you bought in the pool, tell us, I'm real interested in what was the best one and how did that work out? And then vice versa, what was the worst one and how did that one work out?
Best one probably is out of that pool. We bought a note. I can't remember what the price was. I can tell you what a total was. After legal, after transfer, after taxes, all that stuff, we were in it for just under 30 grand. And what we did is we offered the guy cash for keys for deed in lieu. So instead of foreclosure, he signs the deed over to us, and $500. Property was worth 120 grand. So we sold it for 97. This all took place in about 3 months. So we're in it for 30, sold it for 97 in 3 months.
Wow. So that's a $67,000 profit, probably like a 220% return in 3 months?
Yeah, it was awesome.
That's fantastic. So then what was the worst one out of that?
Worst one? Actually, I don't have a bad one at 31, but some of the other ones I got two. One of them is was Indiana. And, there's people out there that tell you only buy occupied properties. My worst properties have been occupied. And the reason is a vacant property, I go by the note, the people I hire to go check it out, they'll get inside or they'll go look in the windows. So we'll get an idea of the condition of that property. Because that's the other thing people don't realize. I'm not buying a property, so I don't get to inspect it. So if I buy the note, how do you inspect that property if it's occupied? So anyway, bought an occupied property in Indianapolis, went through the legal, got the guy out, finally got in it, and they had let termites live in that place for I don't know how many years. Everything was shot. It was a bulldoze. So I donated it for $1 to the land bank. So I lost about, that one wasn't too bad. Well, I say it's not bad. It's all relative. I lost about 14 grand on that one. And then the other one is my pain in Paynesville. I'm finally coming to the end on this one. I think I'm almost at the end of year 2 on this. But I bought it. Once we got the property, got inside, totally shot. I still get offers for this property because the outside looks nice. Inside is demolished, and then the basement wall on the east side is crumbling. So there's all kinds of issues with it, and it would cost me more to fix it than what it would be worth in the end. So anyway, I was going to donate that to the land bank, and then and by the way, I said to get offers on it until they go see the inside, then they withdraw. I'm trying to donate it. Now, I do, when I buy these things, I do title searches, but there's different types of title searches. And I get the, standard, O&E, owners and encumbrances. It's a 2-owner search. It usually works. This one is a freak. Fannie Mae foreclosed on the owner. The attorney on the foreclosure didn't name the state of Ohio as one of the debtors. So when the foreclosure actually took place, that lien wasn't wiped out. So there's a lien from the state of Ohio for $10,000. That's back in 2011, plus interest. So I don't know what it is now. Anyway, I got it. When I got it, I saw the last two owners, Fannie Mae being the first one. I got people I bought from the second one. And there were no liens on those two owners. And I saw the foreclosure with Fannie Mae. So I'm like, all right, that's good. Fannie Mae even had a warranty on it. So I get it. We're trying to donate it. Now we do the whole 40-year search and this lien shows up and I can't donate it now. So I can't even give this property away because it's got a lien on it. And I call the Department of Taxation Ohio. They won't talk to me because I'm not the one it's an income tax lien. I'm not the one with the income tax issue, so they won't talk to me. And I actually had two attorneys, two law firms try and sort this out, and they couldn't. The weirdest thing is I got on the website for state of Ohio. A little screen pops up saying, "Hey, can I help you?" I'm like, "Yeah, this is my problem." And he's like, "Oh, you want to talk to Ruby? Here's her phone number." So, after 2 years of all this crap, I talked to Ruby, and yeah, we sorted it out. So I'm doing a payoff of $800 to get rid of the lien, so I can give this property away. So I sent my $800 off last week, so I should have it all taken care of.
Oh my gosh, it's just so funny because every time I see one of those pop-ups on a website that's like, "Can I help you?" I'm like, boy, that's the last person that can help me. So it's ironic that Ruby, you found Ruby through that pop-up. That's great.
Yeah, that was crazy. But yeah, it's been 2 years now, and I think I've been paying for lawn maintenance. I quit paying on the property taxes because my last option was to let it go to tax sale and to get rid of it that way. But I'm not trying to create blight through this business. So I'm not sitting there letting it overgrow and become a hazard. In fact, I even already paid to have the garage bulldozed and hauled off, and so. Wow!
So you put some money into this property, knowing full well that you would never see any of that back.
Yeah. But like I said, I'm not trying to create problems. I'm trying to improve things. And, it cost me money, but I look at the bigger picture. I got 70-something notes, so, I'm losing on two of them. But overall, I'm making money, so that's how I look at it.
You mentioned something about, just warnings that you have for people who want to get into notes and some of the problems you've seen. Yeah, you care to share any of those?
Yeah, first off, I don't know where you're going to go to learn this stuff. I've had my teachers, but I got to tell you, I'm learning from the School of Hard Knocks about all this stuff because, the teachings are very general. And turns out every state's different. I know people who've bought in states, and it turns out they bought illegally because some states you have to have licenses. Some states, like Kentucky, cost like $30,000 to get licensed to buy notes in that state. And I'm not even talking about foreclosure. I'm talking about to buy notes. You can't even own a note without the license and the bonding. Georgia, you have to have a license. Illinois, you have to have a license. I buy land contracts, but there's a lot of states that it's illegal or not even well defined, like Missouri. That's how there's no laws to define how to handle a land contract. Some people call them contracts for deeds, but basically it's a mortgage where I, the lender, still have the deed. And then the big question is like, well, who's got the equity? In Indiana, I can buy a land contract for on a 360 term, note. So they got 30 years to pay. They made 29 years of payments, and they don't pay that last payment. Legally, I can take that property back, and I don't have to give them a dime, even though they've paid for 99% of the property. Now, if it were a mortgage, they'd have all that equity, and you go to foreclosure, and they'd get most of the money. But a land contract, it's not that way. And so in some states, that's highly frowned upon. And in Missouri, for example, they don't even have it defined. They don't know how to sort it out. So now your legal costs are gone from a flat rate to an hourly rate because you have to pay an attorney by the hour to sort it out. In Georgia, it's up in the air, but it usually leans toward the borrower on how it's handled. Texas, it's illegal if it's 181 days or more. So, yeah. Or if you go stick with mortgages, well, do you buy in New York? Yeah, you can. Boy, it's going to take you 2 years. And you're going to get all the way through that process, and the borrower is going to go declare bankruptcy. Now you got another 5 years of waiting. You know, you'll get some payments, but bankruptcies aren't that pretty. You get paid, but you know, you're not the first in line. So, there's a lot of crying in this game. And if I guarantee you, if someone told me about all this stuff, I might not have got into it. I am in it now. I enjoy it. But it's also about volume too. If you buy 2 notes and you got that one that I had in Indianapolis and that one in Painesville, you're up, 30 grand, 40 grand. Now what are you going to do? You going to go buy another note?
Did you just say there's a lot of crying in this game or crime?
Crying. Yeah, a lot of tears.
The crying game. The notes are the crying game. So here's the thing, because I'm investing in notes too. It does seem like there are a handful of people, more than a handful of people, who know all the ins and outs, kind of like what you just explained, who kind of understand the peculiarities of the different states and their laws and what you need to know and what you don't need to know. So there are those people, and would you say for anybody who wants to get into investing in notes that they should find those people or just find a good attorney in that state? I mean, how would you advise people to actually get into investing in notes?
Yeah, you would need to find somebody that knows it. The only problem is I guarantee you that everybody that invests in notes, and there's my air quotes, they know notes, because who's going to tell you, yeah, I buy notes, but I don't know what I'm doing. There's a lot of guys out there. Their philosophy is it's legal until I get caught. Okay. They will buy in the illegal states. They don't care. They will do it. And as long as no one says anything, they're okay. Problem is, as soon as that someone says anything, now you just lost all those notes. So who do you trust? I've become a big believer in background checks. I've bought from people in notes, or not bought from, I've invested with people in notes. I wish I never did. And there's a lot of shady people in the business. Now I'm not saying crying, I'm saying shady. So, but no, I mean, there's some good people. I'll name some good people. Nathan Turner, he's out of Canada. Out of Florida, Howard Marcella. I think they're honest guys and they care about doing things right. I won't tell you who the bad people are, though.
Okay. So, Adam, as we wrap it up here, you've done a good job of kind of talking about the ins and outs of investing in multifamily today and investing in notes and some of the pitfalls to look for. Do you have any parting advice for our listeners?
I would say that if you're going to do notes, I don't think you can do 1 or 2 and get the business. I'm doing a few dozen of them, and my big home runs are minimized by my losses. Overall, I'm winning, and I do enjoy this. I think I do a lot more nothing doing notes than I was doing with apartments. I'm sitting here talking to you.
What does that mean? You do a lot more nothing doing notes? Are you saying it's easier or it takes less time?
Well, I'm a very organized person, so I know when I need to work and when I don't need to work. So I don't do 20 hours a week. I might do 10 hours a week. I play a lot of video games. I play with a dog, but I'm able to manage everything. It's easy to manage mainly because you're just kind of managing the people that do the work. So I have loss mitigation people, and I just email them when I need to know about our status.
So it sounds like you have a lot of it automated.
Yeah, there's a lot of automation. Other people do the work. I just keep track of when I need to be bugging them. That's it.
If anyone out there listening would like to get a hold of you, how would they do so?
AJA realtyinvestments.com. I think it has my email. I think it has my phone number on there. But yeah, I got some news articles, contact, and I got a few videos because I do the whole CRM thing for notes, software for notes. I don't program it. I just show you how to use this stuff. But how to stay organized so you can do nothing like me too. So
CRM being what?
Customer relation management. I use like Pipedrive. You got Salesforce. You got Podio, Insightly. All kinds of little products out there. But I focus on Pipedrive.
Yeah, I noticed that on your website. You seem to be somewhat of a Pipedrive expert.
Yeah, somewhat. Yeah.
And that CRM, is that keeping track of your investors or the homeowners whose notes you've purchased?
Keeps track of my investments and what stages they're in. So it has my notes, it has my rentals, has my apartment investments, has my hard money loans. So different stages, I have different to-dos, has all my contacts in it, has my email, has everything that I need to run the business.
Great. Well, Adam, this has been a really fascinating conversation. I appreciate you sharing your insight into multifamily and notes, and again, sharing all the pitfalls, because it's not all rainbows and unicorns. There's a lot of things to watch out for, and I appreciate you sharing some of those things. So thanks so much for being on the show.
Oh, man, my pleasure. I enjoyed it.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.